If you want to kill a luxury brand, you don't really have to change the logo.
No, definitely not.
Right. You don't even need a terrible marketing campaign. You just take your premium full-price product and you put it on a clearance rack.
Yeah, that'll do.
And today, the undisputed king of premium athletic wear is, well, they're flirting with that exact poison, and the crazy part is they know it.
They absolutely do.
Welcome to the deep dive. It is Wednesday, March 18th, 2026, and today we are unpacking Lululemon's Q4 2025 earnings report, which just dropped yesterday after the market closed.
Fresh off the press.
Exactly. We have a massive stack of sources to go through today. We've got the official earnings release, the investor slide deck, and the full transcript of the earnings call with interim co-CEOs Megan Frank and Andre Maestrini.
It is a lot of reading, I'm not going to lie.
It's a ton, but our mission today isn't just to, look at stock tickers and rattle off spreadsheets for you. We are looking at the actual anatomy of a brand pivot in real time.
Right, because this is about survival in a changing market.
Exactly. How does a company built on charging top dollar fight back against margin pressure, these massive global tariffs, and a consumer landscape that just refuses to pay full sticker price anymore?
It's a tough spot to be in.
It really is. Okay, let's unpack this. Let's start with the financial reality check, because Q4 was an incredibly mixed bag.
Mixed is a polite way to say it, yeah.
Right. So on the top line, Lululemon actually beat expectations. They hit $3.64 billion in revenue.
Which sounds great on paper.
It sounds amazing, but then you look at the actual profit, and it took a serious hit. I mean, earnings per share dropped from $6.14 a year ago all the way down to $5.01.
What's fascinating here is the underlying metric that completely spooked the market. It wasn't that massive revenue number at all.
No, the revenue was fine.
Right, it was the gross margin. The gross margin dropped a staggering 550 basis points in the fourth quarter.
And for anyone listening who doesn't spend their days, staring at financial terminals, 550 basis points is huge, right?
Oh, it's massive. It essentially means 5.5% of their profitability on the physical goods they sold just vanished.
Wow.
Just gone.
Poof. Compared to the same time last year, anyway. In the world of retail apparel, a 550 basis point drop is, well, it's a catastrophic structural shift.
Because gross margin is basically the ultimate indicator of your pricing power.
Right, exactly. When that number shrinks that drastically, it tells you one of two things. Either the company is spending significantly more to manufacture and ship the product.
Which is definitely happening with supply chains right now.
Right, or they're charging the consumer significantly less at the cash register. And in this specific earnings call, management actually points to two culprits for this drop.
Okay, what are they blaming?
Well, the first is severe tariff impacts.
Yeah.
Which is a macroeconomic headwind we will definitely break down shortly.
Oh, yeah, we have to talk about the tariffs.
But the second culprit, and arguably far more dangerous for the long-term health of the brand, is an overpenetration of markdowns in North America. Oh, man. So they basically had to put their premium gear on sale just to get it off the shelves?
Exactly. They had a discount to move inventory.
And, training customers to wait for a discount is like feeding a stray cat.
That is a great way to put it.
Like, you think you're just doing it once, right, just to clear out the pantry. But now that cat is at your back door every single day.
It's never going to hunt for its own food again.
Never. You've permanently altered the behavioral loop of your consumer. Because once they know those iconic black leggings will eventually drop by 30%, they will literally never pay full price again.
And that behavioral loop is exactly what terrifies a premium brand's management team. Because you are unwinding years, decades of perceived value in a single quarter.
Which is terrifying for investors.
Completely. But, to Lululemon's credit, they aren't burying this in the footnotes.
They're owning it.
Yeah. During the call, Megan Frank, the interim co-CEO and CFO, actively acknowledged a 130 basis point increase in markdowns in Q4 alone.
So they know they are caught in this markdown trap.
They absolutely know it. And because they recognize that danger, they've actually slashed their 2026 profit expectations across the board.
Ouch. What's the new guidance?
They are guiding to $12.10 to $12.30 in earnings per share for the upcoming year.
Which is way down, right?
Yeah, that is down significantly from the $13.26 they delivered in 2025. They are forecasting about 250 basis points of operating margin contraction.
Wow. So they're essentially choosing to take their medicine now just to fix the baseline.
Basically, yeah.
Because if you refuse to rely on that clearance rack, you are forced to invent real reasons for people to pay full price.
Exactly. You have to give them a reason.
You can't just, cross your fingers and hope the consumer suddenly forgets about all those discounts. You have to give them something they have literally never seen before.
A completely new value proposition.
Right. And that desperation for full price buyers leads directly into this incredibly aggressive product-led action plan they're rolling out.
The newness doctrine.
Yes, what I'm calling the 35% newness doctrine.
Yeah.
So historically, their product assortment in any given season was about 23% new styles, right?
Right, which is pretty standard. Safe, predictable, mostly core colors.
Black, navy, maybe a dark red. But for 2026, they are raising that newness penetration to 35%.
That is a massive jump.
It's huge. And based on the call transcript, this isn't just, releasing the same old Wonder Train leggings in some new spring pastel. This is fundamentally new, highly engineered fabric technology.
Pushing your newness from 23% to 35% is a massive operational risk. But honestly, it is the only reliable mechanism to break that markdown cycle.
Because it resets the expectations.
Exactly. It's about reestablishing the value proposition from scratch. If a product is truly unique, like if it solves a physical problem for the consumer that no other garment solves, price resistance evaporates.
Because you can't compare it to anything else.
Right. You aren't comparing it to a discounted pair of pants anymore because there is no direct comparison on the market.
And the transcript was just packed with specific examples of this new gear. Diving into the mechanics of it is actually really fascinating.
They definitely brought out the heavy hitters for this call.
Oh, they did. So first, they mentioned this new franchise called Unrestricted Power. And it's built on a brand new fabric they are calling Power Lu.
Right, the high filament yarn.
Yes. The big selling point here is that it uses their highest filament yarn count ever. And I was reading up on this. Instead of just standard threads, high filament yarns are essentially microscopic bundles.
Okay, so it's a structural change.
Exactly. When you pack more of these microthreads into a single yarn, you create a massive amount of surface area.
Oh, I see.
And that surface area distributes tension and moisture way more evenly across the garment. That's the actual physical mechanism behind their claim that it offers an incredibly soft feel while still giving high-impact support.
So it's a literal engineering solution to a tactile problem.
Exactly.
You are asking the consumer to pay a premium for the physics of the fabric, essentially.
Yes. And then you have Show Zero. This is the one that really caught my eye.
The tennis one, right?
Yeah. It's a no-show sweat technology designed specifically for high-sweat activities. They co-developed this with professional tennis star Frances Tiafoe, and they actually debuted it at the BNP Paribas Open in Indian Wells.
Which is a brilliant marketing move.
It's genius, because think about the mechanics of this. Everyone expects workout gear to wick sweat away from the body, right?
Sure. That's the baseline for athletic wear.
But usually that just means the shirt gets visibly drenched on the outside.
Right, you get the dark sweat patches.
Exactly. But Show Zero acts as a one-way moisture valve. It pulls the sweat off your skin, but the outward-facing layer of the fabric visually conceals the moisture.
That is wild.
I know. You could play 3 sets of tennis in the desert and look like you just walked out of an air-conditioned fitting room.
And debuting that specific technology on a professional athlete during a major tournament. I mean, that is a brilliant proof of concept.
It really is. You can't fake that.
No, you can't. And tennis has a massive, highly affluent following. So by putting it on TFO, they are showing the target consumer the value proposition in real time under the most extreme conditions possible.
Right, like, look, he's not sweating, so neither will you.
Exactly.
And finally, they highlighted Thermozen, which is this big push into premium outerwear. It's a new line of insulated jackets and vests that prioritize extreme softness alongside wind and water resistance.
So they are trying to own the commute to the gym, not just the workout itself.
Yes, exactly.
Thus,
Getting you from the car to the studio in luxury.
all 3 of these innovations, Power Lu, Show Zero, Thermozen, they all show a company leveraging massive R&D capabilities to yank the consumer back to full-price purchasing.
But here's where it gets really interesting.
Okay, lay it on me.
If you read further into the transcript, Megan Frank details a timeline that frankly feels impossible.
The design calendar shift.
Yes, Lululemon is actively trying to shrink their go-to-market design calendar. Historically, it took them, what, 18 to 24 months to get a product from a sketch on an iPad to the physical store floor.
Right, a typical fashion cycle.
But they are currently attempting to crush that down to 12 to 14 months.
But that is a very tight window.
It's crazy. You are telling me they want to radically invent 35% of their entire product line, roll out these complex microfilament fabrics and invisible sweat tech, A&D, they want to do it in almost half the time.
It does sound like a recipe for disaster.
Doesn't extreme speed usually kill product quality? I mean, you can't code your way to a stronger physical stitch.
No, physical manufacturing takes time.
And I remember years ago when this brand faced massive backlash for sheer transparent leggings because of quality control issues. How do they innovate this fast without the seams literally ripping apart on the consumer?
Well, it's the classic project management triangle, right? Fast, cheap, or good. You only get to pick two. But Lululemon is attempting to bypass that rule entirely through what they outline in the deck as their enterprise enablement pillar.
Enterprise enablement. Sounds like corporate buzzword bingo.
It does, but there's real mechanics behind it. The goal isn't to make the human designers draw faster or to force the factory workers to sew faster.
Okay, so what is it then?
It is about fundamentally re-engineering how the supply chain communicates using AI. Management is leaning heavily into automation to predict material needs, manage inventory buffers, and optimize procurement routing.
Oh, I see.
Yeah, by automating the logistical friction that usually stalls a 24-month calendar, you basically buy back months of time for the actual creative and manufacturing processes.
So the algorithms are handling all the boring paperwork and the raw material staging, freeing up the humans to focus purely on the tactile execution.
That is the architectural theory behind the pivot anyway. And addressing your skepticism on quality directly, interim co-CEO Megan Frank actually anticipated that exact concern from analysts.
She knew they'd ask about it.
Oh, of course. She explicitly stated on the call that she has been spending significant time directly with the supply chain team. Her specific mandate is to ensure that as the timeline shrinks, the physical quality standards remain untouched.
Because they know what's at stake.
Exactly. Management understands that if they sacrifice the premium feel of the product, the entire 35% newness doctrine collapses immediately.
Yeah, if a $140 pair of pants pills after 2 washes, the brand equity is just gone.
Completely gone. You'll never get that customer back.
I am still skeptical, honestly, on behalf of the consumer. I mean, it's easy to promise quality on an earnings call, but actually executing a 12-month turnaround on high-tech apparel is a massive operational tightrope.
It's definitely a we'll believe it when we see it situation.
Right. But let's say they pull it off. Let's say the tech works and the stitching holds. Inventing great new fabric in a lab is still only half the battle.
You still have to sell it.
Exactly. To actually sell it at full price in 2026, you have to create an environment that makes the customer feel like they are purchasing a piece of an exclusive club.
The retail experience.
Yes. And looking at the regional data in these sources, Lululemon's execution of this experience looks radically different depending on where you happen to live.
Oh, the geographical data in this report is stark. It's wild.
It really is.
We are essentially looking at a tale of two distinct markets, operating in entirely different phases of the business lifecycle.
The divide is unbelievable. Let's just look at the Q4 comparable sales for a second, which, for you listening, that measures sales at stores open for at least a year, plus their e-commerce channel.
Right, it's the standard growth metric.
So in North America, which is obviously their oldest and most saturated market, comparable sales were actually down 2%.
They are shrinking on their home turf.
Shrinking. But then you look at China Mainland, revenue exploded by 28%, and the rest of the world grew by 12%.
It's like evaluating two completely different companies, depending on which hemisphere you are standing in.
Exactly.
And this discrepancy really highlights the friction of a maturing global brand. In North America, Lululemon is ubiquitous. I mean, you see the logo in every grocery store and coffee shop.
Everybody has a pair.
Right. The challenge there is retention, re-engagement, and fighting off a dozen upstart competitors who are trying to steal market share.
Yeah, the market is flooded.
But in international markets, particularly in Asia, they are still in the aggressive acquisition phase. They are the exciting, aspirational new player in town.
And the way they are activating these international markets is incredibly visual and super grassroots. They aren't just, buying generic billboards.
No, they are getting deeply involved in the communities.
Right. The slide deck and the call highlight some massive localized campaigns. Like in China, they launched a highly specific Chinese New Year campaign featuring the legendary cellist Yo-Yo Ma.
which is such a premium association.
Huge. And in Europe, they outfitted Team Canada at the Milano Cortina 2026 Olympics, putting their proprietary fabrics on the absolute highest stage of winter sports.
You can't buy better visibility than the Olympics.
No, you can't. And the images and the presentation of their regional activations are just striking. You see these massive community-run groups, hundreds of people waving checkered lululemon flags, running right along the harbors in Hong Kong.
They are embedding themselves into local cultural moments rather than just exporting a generic North American yoga aesthetic.
Right, they aren't just copy-pasting Vancouver into Hong Kong.
Exactly. And this philosophy extends directly into their physical retail strategy, too. The actual architecture of their stores is evolving to support that 35% newness doctrine we talked about.
Yeah, Andre Mastrini, the interim co-CEO and president, he spent a lot of time detailing their new store design playbook.
He was very focused on the physical space.
He was. They highlighted newly designed spaces in Soho, New York, and the Gangnam District in South Korea.
And the crucial element of these new designs is the intentional use of negative space.
Negative space, like empty room.
Yes, they are dramatically lowering the product density. So instead of jamming 50 jackets onto a single rounder rack, you might see just 3 jackets perfectly lit on a custom wall display.
Oh, wow. So very minimalist.
Extremely minimalist. By displaying fewer items, they draw the guest's eye directly to the new 35% assortment.
That makes total sense.
It changes the entire psychology of the consumer walking through the door. It feels less like a crowded apparel shop where you might, hunt for a bargain, and much more like a premium gallery.
Right, a gallery where the art just happens to be wind-resistant running jacket.
Exactly.
And when a product is isolated like that, your brain perceives it as an artifact, not a commodity. It makes the gear feel precious, which inherently lowers the customer's price sensitivity.
You're willing to pay more for art than for a commodity.
Yeah.
And if we connect this to the bigger picture, the overarching corporate strategy becomes really clear. Lululemon is actively using its explosive international momentum to buy the time and provide the cash flow needed for the North American turnaround.
Oh, that makes so much sense.
You see this vividly in their real estate pipeline. They plan to open 40 to 45 net new stores globally in 2026.
And based on the numbers, the vast majority of those are not going into American malls.
Far from it.
Yeah.
China is the absolute focal point of their physical expansion. North America is only getting about 15 of those new stores.
Wow.
And the transcript explicitly notes that a significant portion of those 15 will actually be in Mexico, not the US or Canada.
Oh, fascinating.
So they're deploying their capital outward, focusing on regions where the growth is easiest to capture and the margins remain the healthiest.
So they are basically letting the international consumer pay the bills while they take the engine apart and rebuild it in the U.S.
That's a great way to summarize it, yeah.
But, expanding a physical supply chain across the globe to chase this growth isn't free.
No, it's incredibly expensive.
It exposes the company to massive macroeconomic forces. And this brings us to a challenge that no amount of fancy, high-filament fabric can easily fix.
Right. The most prominent of these invisible headwinds, which is heavily detailed in the earnings report, is the brutal reality of global tariffs.
Oh, man. The tariffs, the numbers they reported are just staggering. In 2025, gross tariffs cost the company $275 million.
Which is already a huge hit.
But looking ahead to 2026, Lululemon is forecasting a $380 million gross tariff hit.
It's unreal.
That is an enormous amount of capital essentially evaporating into supply chain taxes before a single pair of leggings even hits a store shelf.
It is a massive financial hurdle. And the specific supply chain dynamic here is that Lululemon manufactures the vast majority of its technical fabrics in Southeast Asia, but a massive portion of its revenue is still generated in North America.
So crossing borders is inevitable.
Exactly. The friction between where the product is made and where it is consumed is heavily taxed by these government import policies. These tariffs directly inflate their cost of goods sold.
Which kills the gross margin.
Exactly. Yeah. Now, management stated on the call that they plan to offset about $160 million of this $380 million hit through internal efficiencies.
Which basically means doing the dirty work behind the scenes, right?
Squeezing every penny.
Squeezing their vendors, renegotiating raw material contracts, optimizing shipping routes to save pennies on the dollar.
But even with those aggressive mitigation efforts, the remaining weight on their balance sheet is profound. As we noted earlier, they expect their overall operating margins to contract by 250 basis points in 2026.
Right.
The geopolitical tariff environment is a major, unavoidable contributor to that contraction.
So what does this all mean? Let's just synthesize the sheer scale of the challenge sitting on the desk at Lululemon headquarters right now.
It's a crowded desk.
It really is. The company has to absorb a $380 million supply chain tax. They have to successfully invent and launch 35% of their product line from scratch. They have to shrink their design calendar by several months, relying on an unproven AI integration. And they have to completely break the psychological habit of North American shoppers waiting for a sale, all while pushing a massive retail expansion in China.
It is a formidable, almost overwhelming to-do list for any executive team.
And to inject even more drama into the situation, they are attempting to execute this multifaceted turnaround without a permanent CEO.
Right, the leadership vacuum.
The company is currently being led by interim co-CEOs Megan Frank and Andre Maestrini, and at the exact same time, the board of directors is undergoing a major shakeup.
A lot of moving pieces.
They just brought in Chip Bergh while saying goodbye to longtime director David Mussafer, and Chip Bergh is a fascinating addition.
He really is.
He's the former CEO of Levi Strauss. He famously had to reinvent Levi's when traditional denim went out of style in favor of, ironically, athleisure.
The irony is rich, yeah.
Now he is sitting on the board of the athleisure giant, helping them navigate their own existential pivot. But still, it's a leadership vacuum right when they need decisive, singular direction the most. How do they survive all of this friction at once?
Well, the lack of a permanent CEO certainly introduces a layer of operational uncertainty. However, it is vital to remember the structural foundation of the business.
Okay, what's the silver lining?
Despite the margin contraction, the tariff hits, and the leadership musical chairs, Lululemon is operating from a position of immense financial strength.
Right, they aren't going bankrupt tomorrow.
Not at all. They are not a distressed asset trying to survive the winter. They are a highly profitable entity trying to optimize their next decade.
They have a massive war chest. I mean, they ended the quarter with $1.8 billion in cash on hand.
A lot of flexibility there. And beyond the cash, they also have $1.2 billion remaining in their share buyback authority.
Let's briefly break down why that buyback authority is such a powerful tool, because it sounds abstract, but it's huge.
It is.
Think of the company's total shares like a limited run of vintage baseball cards, right?
Okay, I like this analogy.
If there are 100 cards in existence, they hold a specific value. If the company uses its cash to buy 20 of those cards off the open market and locks them in a vault forever, the remaining 80 cards instantly become rarer and more valuable to the people holding them.
Simple supply and demand.
Exactly. By having $1.2 billion authorized to buy back their own stock, Lululemon can artificially support their share price and keep investors happy, even while their profit margins contract.
It is a profound safety net.
Yeah.
That level of liquidity ensures they have the capital required to weather the macroeconomic storm, build out those premium gallery-style stores in South Korea, and fund the expensive R&D for fabrics like Powerloo and Show Zero.
Regardless of who is temporarily sitting in the captain's chair.
Exactly.
It's basically the ultimate luxury in corporate retail, having enough cash in the bank to buy yourself the time to fix your fundamental problems without panicking.
Absolutely.
So, bringing this all home for you listening today, why does this deep dive into an activewear company's earnings matter to you?
Good question.
Whether you are an investor looking at retail stocks, an entrepreneur building your own brand, or just someone trying to understand the hidden psychology behind why your jacket costs what it costs, Lululemon is offering a live masterclass in brand discipline.
They really are drawing a line in the sand.
They are actively choosing to take short-term financial pain. They are slashing their profit guidance and enduring severe margin contraction. And they are doing it intentionally to protect the long-term premium status of their brand.
Which takes guts.
It does. They are refusing to let the clearance rack define their identity.
It is a remarkably courageous strategy in a financial environment that usually demands immediate, quarter-by-quarter gratification.
Absolutely.
But as we examine their methods, specifically the reliance on enterprise enablement and algorithms to compress their supply chain, it raises a critical question for the future.
What's that?
Well, Lululemon built a multi-billion-dollar empire on grassroots, highly localized human connections. The local yoga instructors, the community-run clubs, the authentic studio culture.
Right, the human element.
Exactly. As they shrink their design cycle to a rapid 12 months and lean heavily on AI to predict human trends and manage their inventory,
Right.
can a brand born with that kind of organic human soul maintain its authenticity?
Wow, that is the question.
Or will the relentless pursuit of algorithmic efficiency fundamentally change what the logo stands for?
That is the multi-billion-dollar question right there. Will the algorithm actually build a better, more supportive yoga pant, or will it just build a more efficient financial transaction?
Time will tell.
It makes you wonder if that luxury car lot from earlier is just getting a fresh coat of paint, or if they're actually building a completely different, soulless engine under the hood. Thank you for joining us on this deep dive. Keep questioning the numbers behind the headlines, look closely at why things go on sale, and we'll see you next time.